Welcome to EDHEC Risk Institute. Today we are going to talk about robo-advice and also the relationship between robo-advice and artificial intelligence, which is, of course, an extremely heatedly discussed question, and the impact of artificial intelligence in investment management. Well, the first question that we need to think about is whether robo-advisors are useful. So remember, in the previous video, we introduced the robo-advisors, we discussed them, we talked about whether they could be regarded as a threat or an opportunity to existing players, but we haven't asked the important question from the standpoint of the end users, the investors. How about the usefulness of these robo-advisors? So we do expect digital disruption in many different fields to have a dramatic impact, and we know that wealth management as we know it is going to be dramatically impacted by digital services. And the question is, how much improvement, if any, are we going to get in the end? There are two types of potential improvements that one could expect. On the one hand, we could expect lower cost, right? We get advice through a machine as opposed to get advice through a human being, and therefore the advice should be easier and cheaper to provide. On the other hand, the question is, are we going to get a better service? And all those discussions about artificial intelligence, maybe those machines are in some sense not smarter than humans, but better able to address our needs. And that would be even better, that they are less expensive and better. So let's try and understand how they behave with respect to those two dimensions. Well, on the cost side, I think it's fair to say that we get a huge improvement compared to traditional wealth management services. Traditional wealth management services are very expensive. We're talking about things in the order of magnitude of 100 basis points. 1% of someone's wealth on an annual basis is spent on those services. And the 1% is just the wealth management services themselves, keeping in mind that typically more fees are applied at the level of the building blocks that wealth managers are using to implement the portfolio. Having said this, if you think about online brokerage, it's already very inexpensive to get access to, buy stocks and bonds and, ETFs and, portfolios. So in terms of costs, we are talking about much less expensive than traditional wealth management, but not less expensive than online brokerage. And if anything, it's actually more expensive than online brokerage. And the reason why it's more expensive is because we are supposed to get the additional source of added value, which is the investment advice, which you don't get typically with an online brokerage service, where you just go and buy the securities. Well, so precisely now turning to the service side, the question is, how much more do we get by using a robo-advisor compared to using an online broker? And in terms of service, are we going to get something as good as what we get with traditional wealth managers, or maybe better than what we get with traditional wealth managers, or not? If you think about the analogy, it's just like from a physical health problem, we need both the medicine, the pills, and we need the advice from the doctor. So the medicine or the pills, we already get them from online brokerage. So what we do expect in terms of service from the robo-advisor is to have a machine or an algorithm put together somehow a portfolio that is actually meaningful with respect to my needs, and the portfolio we hope to be customized to meet my needs. Well, that's the question. Do we or don't we get meaningful advice by robo-advisors? Are they very useful? If you think about what wealth management services are all about, it's all about having meaningful building blocks. And remember, in a previous video, we discussed about the smart factor indices as very meaningful building blocks. And then we need a goal-based investing process, which we talk about also in another of those previous videos, to put together the building blocks in such a way so as to maximize the probability for us to reach our goals. Now, clearly, robo-advisors give us a cost-efficient access to underlying securities. They also give us a goal-based dialogue. In other words, it's very easy using a digital device to incorporate information about my goals, my needs, and when am I going to retire, and how much money do I need in retirement. So these are very easy in terms of interfacing. But I think it's unfortunately fair to say that the smart building blocks and the mass customized allocation to the building blocks are still missing. There's actually, which is sad, fairly little connection between the dialogue interface, the front end of those robo-advisors, which is very friendly, investor friendly, I mean. So they are asking you or allowing you very easily to provide a lot of meaningful information about your needs. But in terms of the back end, well then, there's not much of a meaningful portfolio that typically is designed, and the portfolio which is being designed is not necessarily optimized to meet your very specific needs. To make a long story short, if you look at what the kind of technology that they use a technology that they call, modern portfolio theory. That's what they use. Markowitz analysis, efficient frontier analysis. Well, the bad news is we're talking about some piece of technology that we've been calling modern portfolio theory for the last 70 years. And there's nothing modern about modern portfolio theory. 50 years later, we presumably have a better technology at our disposal to do these things. Anyway, so if you look at the list, and so we've looked very carefully at the list of all of these largest robo-advisors, and everything that they talk about is MPT, modern portfolio theory, Nobel Prize winning portfolio construction methods. Again, Markowitz, that's what they talk about. There's only one of them, Betterment, who kind of emphasizes the goal-based investing aspect of things. Now, it's actually not exactly goal-based investing that they do. They actually do goal-based reporting and goal-based dialogue. So the dialogue is definitely around the needs of the client, which is great, and that's a very good step forward. But we have reasons to believe that the portfolio that you end up having is not optimally constructed in such a way that it would allow you to maximize the probability of reaching those needs. Okay, so what is missing? I mean, these robots are supposed to be extremely smart, and they are like algorithms and machines, and maybe, presumably using things like artificial intelligence, machine learning, they potentially should be in a position to help us in a more effective way. Well, in investment management, it is fair to say that machine learning techniques seem to be extremely promising. And we're still at the early stages, so it's a bit hard to understand how useful they are, but we have reasons to believe that they are somewhat useful. In particular, they allowed us to provide and to get new perspectives on existing data sets. So if you're looking at a set of returns, and if you're trying to pick stocks or form portfolios, or understand better the behavior of some factors in different market conditions, then some robust machine learning techniques might actually prove to be a very good complement to the standard statistical techniques. Now, clearly, the place where they are most useful is when it comes to analyzing alternative data sets, especially those very large, big data sets. So what are we talking about? Well, we're talking about natural language, where we're trying to do some kind of sentiment analysis through searches on the internet of occurrences of the company's name. So that's very kind of powerful way of trying to understand how much attention there is to this company. We are talking about satellite images of whatever, parking lots of retail distributors in the US, and you think about that as an early signal, early indication of consumption and demand. So I mean, there are a number of new large data sets that can actually prove extremely powerful in investment management decisions. On the other hand, it's kind of unclear how much, if any, of that technology can and should be put at use in robo-advice. I mean, when you think about robo-advice, it's not like a big data problem. I mean, it's a small data problem. We have one individual. Okay, we have many of them, but each one of them is a small individual. I mean, is one individual with a small number of pieces of information that we need to process. So I think the question is more, having the right focus on what matters, which is investor goals. So the real challenge is how to use properly available information about investor goals as opposed to, try and be extremely fancy in terms of using machine learning techniques in robo-advice. In the end, what's our conclusion? Is the glass half empty or half full? How far are we on that, journey towards having an extremely effective digital wealth management service available to us? Well, I mean, I think we are clearly halfway towards the emergence of truly meaningful, cost-efficient, mass-customized investment solutions for individuals. We're not there yet. We've made a few steps and few very meaningful steps, but we're not there yet. We have cost efficiency, which is great, which is better than having a retail distribution network. We also have a meaningful investor dialogue, which is extremely important, and that is very good. Now, on the other hand, what I'm missing is, something like having access to smart factor indices. By and large, so far, these smart factor indices are mostly used in institutional money management and not in individual money management. Plus, we do not have, by and large, at our disposal, a goal-based investing process that efficiently optimizes access to these available building blocks to maximize the probability of reaching the target. I think we should remain confident because all of the pieces of the puzzle are now available. So the industrial revolution is happening as we speak. It's essentially history in the making. It's happening. We just have to put all the pieces of the puzzle together. And this comprehensive framework is slowly but surely kind of taking shape. Well, clearly, I think it's fair to say that the wait has already been so long and too long, right? I mean, we've been looking at inefficient wealth management services and portfolio management services for many years now. And the good news is kind of, the pace of change is accelerating, in part because the millennials are coming along and that's also part of the, digital disruption. Whenever they become net savers, the way wealth management services operate is going to be dramatically different. Well, as a conclusion, it has been a pleasure for me to have these video presentations, and I'm now very much looking forward to meeting you in person. As you know, we are going to have those trips to different places, and we're going to try and meet as many of our alumni friends as possible so that we can engage in more discussions around these fascinating questions, which I know are of interest to you, just like they are of interest to me. So I'd just like to thank you for your attention, and I'm just telling you, well, we'll see you soon. Thanks a lot.